The student loan payment pause has been a lifeline for millions of borrowers who have been struggling financially due to the COVID-19 pandemic. According to the Department of Education, the payment pause has saved borrowers nearly $200 billion in interest and fees since March 2020. That's an average of $2,000 per borrower. But what can borrowers do with that money? And how can they prepare for the end of the payment pause, which is currently scheduled for June 30, 2023? One option is to continue paying student loans during the pause, if possible. This can help borrowers reduce their debt more quickly and save money on interest in the long run. That's because during the pause, all payments go directly to the principal balance of the loan, after any interest that accrued before March 13, 2020, and any fees for defaulted loans are paid off. This means that borrowers will pay less interest when payments resume, since they will have a smaller principal balance. Another option is to use the money saved from the payment pause to build an emergency fund, pay off high-interest debt, or invest for retirement. These are all smart financial moves that can improve borrowers' financial security and well-being. An emergency fund can help borrowers cope with unexpected expenses or income loss. Paying off high-interest debt can free up cash flow and reduce stress. Investing for retirement can help borrowers take advantage of compound interest and tax benefits. Of course, not all borrowers have extra money to spare during the payment pause. Many borrowers are still facing hardship and uncertainty due to the pandemic and its economic impact. For these borrowers, the payment pause may be a much-needed relief that allows them to cover their basic needs and avoid defaulting on their loans. Whatever borrowers decide to do with their money during the payment pause, they should also keep an eye on the developments regarding the student loan forgiveness program that President Biden has proposed. The program would cancel up to $10,000 of federal student debt per borrower, but it is currently facing legal challenges from Republican lawmakers who argue that it is unconstitutional. The outcome of this legal battle could affect whether the payment pause will be extended again or not. Borrowers should also stay in touch with their loan servicers and update their contact information if needed. Both the Department of Education and the loan servicers will notify borrowers before payments restart and provide them with information on how to enroll in income-driven repayment plans or apply for deferment or forbearance if they need more time or assistance. The student loan payment pause has been a historic opportunity for borrowers to save money on interest and fees, and to use that money for other financial goals or needs. But it won't last forever, so borrowers should make the most of it while they can. While most federal student loan borrowers have been enjoying a payment pause and 0% interest rate since March 2020, some borrowers are not covered by this relief and have to continue making payments on their loans. These include borrowers with federal family education loans, FFEL, and private student loans that are not held by the U.S. Department of Education, ED. In this section, we will explain why these borrowers are excluded from the payment pause policy and what options they have to manage their debt. The payment pause policy was authorized by the CARES Act, a federal law that provided emergency relief for various sectors affected by the COVID-19 pandemic. The law gave ED the authority to suspend loan payments and interest accrual for eligible federal student loans until September 30, 2020. The policy was later extended by former President Trump until December 31, 2020, and by President Biden until June 30, 2023. However, the law did not cover FFEL and private student loans that are not owned by ED, because ED does not have legal authority over these loans. FFEL loans are federal student loans that were issued by private lenders before July 1, 2010, under a program that was discontinued by the Obama administration. Some of these loans were later purchased by ED during the 2008 financial crisis, but many remain in the hands of commercial lenders or guarantee agencies. Private student loans are loans that are issued by banks, credit unions, or other financial institutions without any federal guarantee or subsidy. These loans typically have higher interest rates and fewer repayment options than federal student loans. Borrowers with FFEL and private student loans that are not held by ED have to continue making payments on their loans during the payment pause period, unless they qualify for a deferment or forbearance based on their individual circumstances. A deferment is a temporary suspension of loan payments for a specific reason, such as unemployment, economic hardship, or military service. A forbearance is a temporary reduction or postponement of loan payments for a limited time, usually due to financial difficulties or other reasons beyond the borrower's control. However, deferment and forbearance are not automatic and require the borrower to apply and provide documentation to their loan servicer. Moreover, interest will continue to accrue on these loans during deferment or forbearance, unless the borrower has a subsidized FFEL loan or Perkins loan. This means that the borrower's loan balance will increase over time and they will end up paying more interest over the life of the loan. Therefore, borrowers with FFEL and private student loans that are not held by ED should consider other options to reduce their debt burden and save money on interest. One option is to consolidate their loans into a direct consolidation loan, which is a federal loan that combines multiple federal student loans into one loan with a single servicer and a fixed interest rate. By consolidating their FFEL loans into a direct consolidation loan, borrowers can become eligible for the payment pause policy and other benefits of federal student loans, such as income-driven repayment plans and loan forgiveness programs. However, consolidation may not be beneficial for all borrowers, as it may extend their repayment term, increase their total interest cost, or cause them to lose some benefits of their original loans. Another option is to refinance their loans with a private lender, which is a process of replacing one or more existing loans with a new loan that has different terms and conditions. By refinancing their FFEL or private student loans with a private lender, borrowers may be able to lower their interest rate, reduce their monthly payment, or shorten their repayment term. However, refinancing also has some drawbacks, such as losing the benefits of federal student loans, paying fees or penalties for prepaying their original loans, or having to meet stricter credit and income requirements. In summary, some student loan borrowers are not covered by the payment pause policy because their loans are not held by ED. These borrowers have to continue making payments on their loans or apply for deferment or forbearance if they face financial hardship. Alternatively, they can explore consolidation or refinancing options to lower their interest rate or change their repayment terms. However, each option has its pros and cons and borrowers should carefully weigh them before making a decision.